If you've spent any time with a true strength indicator, there's a good chance you've run into this scenario. You see the TSI line cross above its signal line. The move looks clean, the logic seems sound, momentum just shifted bullish, so you buy. And then price does something that has nothing to do with what the indicator suggested. This is one of the most common sources of frustration I hear from traders working with momentum oscillators, and I want to be clear about something right from the start. The problem here isn't the indicator, and it isn't the trader. The issue is structural. It comes from a misunderstanding of what a crossover signal is actually telling you and what it isn't. The TSI is a tool I've used as my primary momentum indicator for a long time across thousands of trades, and I have a lot of confidence in it, but that confidence comes from understanding its role correctly, and that's what this video is about. I'm going to walk you through why the crossover's trigger interpretation breaks down, how professionals actually think about TSI signals, and what the correct framing looks like for position trading. Now, this isn't about fixing your discipline. It's about correcting a structural misunderstanding that's very easy to fall into. The logic behind trading TSI crossovers as direct entry signals is actually quite reasonable on the surface, and here's how it reads. The TSI has two lines, the main TSI line and a signal line, which is a shorter moving average of the TSI itself. When the TSI line crosses above the signal line, it means short-term momentum has accelerated beyond the smooth baseline. And that looks like a bullish shift. When it crosses below, that looks like a bearish shift. So the interpretation is a crossover up signals a buy and a crossover down signals a sell. It's clean, it's visual, it gives you a clear, defined moment to act. And compared to some other oscillators, the TSI produces smoother, less noisy crossovers due to its double smoothing design. That cleanliness actually reinforces the idea that these signals are meaningful on their own. There's also something intuitively appealing about the idea that a shift in momentum is the signal. If momentum just turned bullish, shouldn't that be your cue to get long? And that reasoning makes sense. It's grounded in the idea that momentum precedes price, and to some degree, that's true. So, I want to be fair to this approach. It's not random, it's not careless. It comes from a reasonable reading of how the indicator works. And the issue isn't the logic in isolation. The issue is that the logic is incomplete, and that incompleteness has real consequences in live markets. The core problem with treating the TSI crossover as a standalone entry signal is that a crossover tells you about momentum in one dimension only. It indicates that short-term momentum has shifted direction relative to its recent average, and that's it. It tells you nothing about the direction of the broader trend. It tells you nothing about where price is relative to structure, and whether you're near a major resistance level, inside a consolidation range, or in the middle of an extended move. And it tells you nothing about whether the momentum shift has any size behind it, or whether it's just the market breathing. On higher time frames, this matters enormously. Position traders are working with daily and weekly charts, and at those time frames, a TSI crossover can occur many times inside a single trend move, both in the direction of the trend and against it. If you're treating every cross as a signal, you're going to be taking a significant number of trades that work directly against the dominant directional move. There's also a frequency issue. In ranging markets where price is moving sideways without clear directional conviction, the TSI can produce a series of crossovers in quick succession. Each one looks valid, and each one fails. And that's not a TSI failure. That's what a momentum indicator does when there's no momentum to measure. The signal isn't wrong, it's just being asked to operate in an environment it wasn't designed to resolve on its own. The 2-point distance filter I use, treating a crossover as valid only when the gap between the TSI and the signal line exceeds 2 points, helps reduce some of this noise. But even that filter doesn't address the deeper structural issue. A momentum signal needs context to be meaningful. When I look at a TSI crossover, I'm not asking whether it happened. I'm asking what it means, given everything else I'm already looking at. And the first question I ask is, what is the trend doing? I use the least squares moving average to define trend direction on the charts I work with. If the LSMA is pointing higher and price is above it, I'm already oriented bullishly. And in that context, a bullish TSI crossover is confirming something I already suspected. It's adding weight to a directional view I've already formed. And that's a very different thing from the crossover creating the view. The second thing I'm thinking about is what price structure is telling me. If I can see a recognizable chart pattern, a double bottom, a head and shoulders, a clear support level being tested, then a TSI crossover that aligns with a break or rejection of that structure is meaningful. The structure gives me the reason. The TSI gives me the momentum confirmation, and together, they're telling a coherent story. The third thing I pay attention to is the broader behavior of the TSI, not just the crossover, but where the indicator has been. Has it been trending in one direction for several weeks? Has it been making higher lows alongside price? That kind of sustained behavior tells me something about the underlying momentum environment that a single crossover can't communicate. I use the TSI to answer a question, not to ask one. The question, which direction and why, gets answered by everything else. The TSI confirms whether the momentum picture is consistent with that answer. It's worth understanding why the crossover as signal approach keeps circulating, because it does, and it's been around for as long as oscillators have been part of retail trading. Part of it is simplicity. A crossover is visible. It's a clear, defined event on the chart. In a discipline that requires considerable patience and judgment, a mechanical trigger feels reassuring. It seems to remove ambiguity, and in environments where that actually works, strong trending markets where crossovers happen cleanly in the direction of the dominant move, it can produce a run of successful outcomes that reinforce the approach. The other part is how most traders first encounter indicators. They're introduced as signal generators. The tutorial says, when this line crosses that line, act. That framing is baked in early, and it's hard to undo, especially when the indicator's documentation often describes the crossover as the primary signal without sufficient context for what should surround it. There's also a time frame mismatch that drives a lot of this. The crossover approach is more defensible in very short time frames where momentum shifts are the primary driver of price. Traders who've had some success with it on lower time frames sometimes carry that framing upward into daily and weekly charts, where the market dynamics are fundamentally different and where context carries far more weight than signal frequency. None of this reflects poorly on the traders using it. It reflects how these tools are typically taught and how easily a partial understanding can look complete until it's tested across a range of market conditions. At position trading timeframes, the TSI earns its value as a confirmation layer, not as the starting point of any decision. The starting point is always the broader picture. What is the trend on the daily or weekly chart? And what does price structure look like? Are there identifiable patterns, key levels, or areas of confluence that give you a directional reason to be interested in the trade? Those questions get answered first using trend tools and price structure analysis. And once I have a directional view and a structural reason, I look at the TSI to ask whether the momentum picture is consistent. A bullish crossover that aligns with an upward trending LSMA and a breakout above a key resistance level is a convergence of three separate inputs telling the same story. That convergence is what gives a position trading setup its weight. Divergence is another area where the TSI adds real value at higher time frames. When price makes a new high, but the TSI makes a lower high, that tells me the move is happening on weakening momentum. Now, I'm not going to short just simply because of that, but it does change how I'm thinking about managing an existing long position, or how cautious I am about adding to a new one. The overbought and oversold readings, when the gap between the TSI and signal line become extreme, are also informative in this context, not as reversal signals, but as indicators that momentum is stretched. In position trading timeframes, stretched momentum often resolves over time rather than a sharp reversal. Knowing that helps you stay patient rather than reacting to what appears to be an extreme reading. The consistent thread through all of this is that the TSI works best when it's confirming, not initiating. Give it something to confirm, and it becomes a genuinely useful part of your analytical process. Momentum indicators have a specific job. They measure the strength and direction of a price move. They don't evaluate the trend, they don't assess structure, and they don't weigh fundamental context. When you ask a momentum indicator to do those things, to tell you when to enter a trade without any surrounding framework, you're asking it to be something it wasn't built to be. The TSI is one of the better designed momentum oscillators available to retail traders. Its double smoothing produces cleaner signals than most. Its divergence readings are easier to interpret than those of more sensitive oscillators. And when it's used correctly, as a confirmation layer inside a complete analytical framework, it adds real, consistent value. But that value only appears once the framework is in place. Trend direction, price structure, structural reasons to be directionally interested. The TSI confirms those things. It doesn't replace them. If you've been frustrated by momentum indicators that don't follow through on their signals, the most useful thing you can do isn't to look for better settings or a different indicator. It's time to step back and ask yourself what you're surrounding the signal with. That's where the answer almost always lives. The full article for this video, True Strength Indicator Trading, 3 Winning Methods, is available on positionforex.com and linked in the description. It covers everything discussed here in written form, including a full breakdown of the 4 TSI signal types, the 3 combination methods I use in my own trading, and the framing that makes momentum confirmation actually work at higher time frames. If this video raised questions, the article is the right next step. And until next time, best to your trading.